Financing Fridays. Hello, everyone. I'm happy to be joined today with Dan Norville, who's president and founder of Vivo Investment Group. Here, Dan, I know you have a lot of experience in it, and it is what people need a lot of help on in this business, and that's the financing side. And I'm wondering sort of your view or something you've been doing lately to overcome some of these hurdles. Share something about what you're doing now, or if it'd be more interesting in your opinion, you could go back to some point in time where you did something creative with financing and share with us.
Yeah, what I'm doing now, financing is not very accretive, right? When you talk about accretion and where cap rates are and where perm debt is on a stabilized asset today, when debt is 6.5%, 7% for multifamily and everyone's still buying at 5 caps or 6 caps, I'm really scratching my head these days and looking at that. And then on perm, that's perm loan side. But when you're talking the side of bridge loans, right, the loans that we need for our projects, those are in the 10 minimum percent range, really more like 12, 13 for most newer sponsors. We're generally closer to that 10 these days with our reputation and track record. But it's a big clip, right? That's like a preferred equity type of return. So is it very accretive? Not in my mind. And really how we pivoted these days, we're not taking on more than 60% LTC on any of our deals, right? We're looking at more like 55, 58, given it's not very accretive to have that debt in place until you can get to the perm loan. And once you get to the perm loan, get hopefully a nice cash out refi, whether it's agency debt with Fannie or Freddie, or not really HUD with us, but Fannie or Freddie, with an affordability discount. With Freddie, we get the ESG, the affordability, and the green discount comes up to about 65 basis points off the loan rate, which is great. And you put that in place, try and get as much IO as possible, get some cash back to investors through the perm refinance. That is accretive debt, where it's at, our last year was at 5.6. That one's gone now, right? We're at now close to 7 these days, high 6s. Hopefully it'll come back down, but I'm not banking on it. If we're in the 6s, that's a long-term interest rate when you look over the last 30 years. So do we bank on a decrease? I wouldn't. And I'm not banking on a decrease again in cap rates either. So we're underwriting for higher, longer, forever. Who cares? We want to be able to be comfortable with staying power. And Jack DeBoer's book, the founder of Residence Inn, who founded that brand and many others, multi-billionaire. I worked on a deal in 2007, investment banking for now it's Wood Spring Suites, but it was Value Place. Read his book, and his quote, my favorite quote that he said was, if you have staying power in real estate, you'll always make money, right? And that, I think, is really the number one rule in real estate. Don't over leverage, have the staying power. When rates are this high, doesn't give you great staying power to use a lot of that kind of debt, right? So keep it low, keep it minimal. It's not going to affect, it's actually going to increase your stabilized return on cost by using less leverage, not more these days, because the leverage is so expensive. And it's going to increase your cash on cash and your multiple on exit. It'll hurt your IRRs, and people, I think, are far too caught up on IRRs. And when you look at it that way, yeah, it's not as accretive, but look at all the other intangibles. I don't even think they're intangibles. They're very tangible risk. So yeah, keep it low, keep it safe, especially in this environment. And creative stuff, I prefer not to get too creative. I can get very creative with my finance background, but I think too many people push a lot of numbers around on spreadsheets, and real estate's not that complicated. If you've been doing it long enough, 20 years, like I've been, you can size up a deal real quick. And there's really only like 3 specific metrics that you need to look at, and that should govern your decision. And outside of that, you're really just playing in the margins and moving numbers around on an Excel spreadsheet. It's fun, but I don't think it adds value.
Well put. Amazing. It just in your answer, I know that you're great at underwriting deals. It's just, I've learned enough in my last 5 years of doing this full time to know when I'm talking to somebody that knows what they're talking about, and you obviously do. So 55 to 60% LTC, yeah, absolutely. Don't count on interest rates coming back down. They were too low for a long time for some weird reason. A lot of people don't know. Like when I got my home in 1999 and had this built, I was way higher. I was higher interest than what people are paying now. So like we've had high interest rates before, depending on where you were at the time in your life and what was going on. Obviously 70s and 80s, like early on. So I guess no one should expect, like you said, the interest rates to come down. The cap rates, exactly. My mind is blown away by how many deals come into my inbox every day that say they're good and say they're value add and say that, and I look at and I go immediately to the source and uses, and then I immediately look at the yield on cost, and I look at the assumed cap rates and sensitivity tables, and I'm like,
you scratch your head.
It's like, yeah, exactly. I don't know what people are thinking. Were you really counting on a lot, right? Or even better is like, hey, not only is this going to appreciate, but we're going to refinance at this point. You can count on that money, and then we're going to exit at this cap rate. We can count on that, and it's an opportunity zone, so count on that too. Like, no.
Well, to case in point,
That's
a lot of our deals qualify for property tax abatement. The Charleston deal that you and I are talking about, we can and will get property tax abatement on that project. But did I underwrite it? Nope. It's a entitlement program. It's a government program. It's nice to have, but it's not something that I'm going to underwrite into the deal just to fluff up the numbers and hope that the next buyer underwrites it into perpetuity on the cap rate or into the income. But it'll be nice cash flow along the way for the 3 to 5 year hold. But really, it's just all looking at it over 30 years, right? Look over a 30-year average and say, where are we today compared to the last 30 years? And we're pretty much right in line at this point. So to think that there's going to be some windfall that's going to bring us back down to 2% interest rates is, I think, a real fallacy. And they held them for far too long. I mean, I started betting against interest rates in 2018 and 19. I was way too early, and my bets didn't pan out. Betting against interest rates staying that low for as long as they did, and then COVID kept them down, but it was far too long. It just took way too long for that to go where it should have gone. And now we're going to pay the price, but it's breeding, I think, some of the best opportunities that we're going to see, at least for the decade, maybe longer. I bought a lot in 2009 and 10 when nobody was buying. We raised a fund, deployed it. It was not easy to raise money. It's not easy to raise money right now for that same reason. When others are fearful, right? They're sitting on the sidelines. And I'm looking at it over the long term and saying, okay, as these deals start to come to roost, and I can buy multifamily traditional, I don't always need to buy a hotel and convert it. Right now, I think I'm going to see a lot of deals at 7 caps, 8 caps that I can buy right now at those cap rates, which are just good long-term buys, good cash on cash. We made sure we were walking into, back in 2009, we wouldn't underwrite anything that didn't have less than a 10% cash on cash year one in our strategy. And that's something you can see, touch, and feel. Even when the world's falling around you into disarray, you feel good about it. You're like, all right, based on where it is today, I'm getting a good yield for my risk. And of course, rents went up 40% over the next 4 years, and we absolutely killed it. But that's why I like to look at it.
Yeah, well, that's great. Risk mitigated. You gave us a bunch of good information today, Dan. You've shown why anybody who's looking at our fund, our new Froggy Fund 1, Fund of Funds, as you know, will know why you're near the top of the list of guys that we're going to invest in. We'll be knocking on your door every time, seeing what deals you have, looking to invest and deploy our capital into your deals, and then learn from you if we're able to do something here locally where we develop ourselves in New England and make some of those strategies work. But it's been a pleasure talking to you. And you want to tell our listeners how they could get in touch with Vivo or NorCap, or what's the best way to find you guys?
VivoLiving.com. We've got a inbound request form for any kind of questions or leads, and our team's always checking the website and taking those into account. So happy to field any questions or just talk shop just like this. It's always fun.
Thanks, Dan. Thanks for your time today. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.